Hello traders, Thomas here from VegaFX, and in this video we're going to be looking at how to incorporate imbalance and liquidity into our supply and demand zones. If you do enjoy the video, it would mean the world if you hit that like button, and if you did want to stay updated with my latest content, you can subscribe and ring that bell button. Now without any further ado, let's get straight into the video. I hope you guys enjoy. Supply and demand zones do vary between traders a great deal. Many don't look at liquidity and imbalance whatsoever, and the ones that do use different combinations and techniques to define their zones. Now today, I'm going to show you the techniques that I have personally picked up on over the years of trading, and I'm going to give my reasoning on why they are so effective to use and how we can profit greatly from them. Now, before we begin, we do have to define what imbalance and liquidity is, just so we can use them within our strategy. Now, imbalance is the difference between buy orders and sell orders in an order book. And although we are not technically viewing the order book when we look at a chart, we are looking at the price movements due to imbalance. Imbalance can, however, be seen on a chart through candles, and as shown in a previous video, it does show when every other candle's opposing wicks don't meet each other. Now, by using this method, it actually can take quite a long time and it is prone to human errors. We can fix that by simply using an indicator to do it for us. And you can see that it's turned all the imbalanced candles to black. And we can even see that this candle is turned black as there was a tiny amount of imbalance where the two other candles didn't meet. Now, imbalance is important as this is where there are unfulfilled orders in the order book waiting to be fulfilled, and the market will be drawn back to this like a magnet simply due to market efficiency and engineered price action. Now, liquidity, on the other hand, is the amount of orders within an order book that allow an instrument to be bought and sold at one price without the market moving. And again, although we can't see the order book, we do know that liquidity is built up above and below market structure, and the market will target this, such as BFIs, to build larger positions and move the market back to favorable areas. Now, as we can see in the example, guys, we can see that the imbalance is bullish. We can also see that we've had a break of major swing structure by here, so the momentum is bullish, and the swing high is likely to get taken out for order flow to continue. So we can follow the imbalance back. We can draw our demand zone at the bottom of the liquidity, and this is where the source will be. This is where the unfulfilled orders will be left in the bank. All the orders in this zone should have been mostly mitigated. We know that there is a very good chance that the imbalance was caused by an imbalance in orders, meaning there is likely unfulfilled orders at this zone. Now, if we start drawing liquidity, guys, we can draw liquidity in our favor. We can see that there is liquidity to the upside. This allows the market to continue on its order flow. And we have liquidity here, which we call inducement for our zone. This allows the market to sweep in, tag us into our zone, and then targets the liquidity that's been built up above here. So we're going to start playing price and we're going to see what happens. So the market has tagged into our zone after sweeping this liquidity that's been built up. We can actually see that there is actually more liquidity built above here. You can draw dynamic liquidity like this. You just need to know that liquidity builds up above all market structure that hasn't been swept. So buy side liquidity will form below lower highs, and sell side liquidity will form below higher lows. We get some equal highs by here, guys. This is even more liquidity. And just to note, the more horizontal the market structure is, the more liquidity builds up. We've had a sweep of that. We've got some more equal highs by here. You'll know that there's liquidity building up by here. And we may get a tap by here, simply building more liquidity. before the market continues. So we zoom out, guys. This is actually on the EU. I'm going to scroll down. Now, this is actually a trade that I've taken to date with my community members. And this is a little different. We did have, obviously, buy-side liquidity built up, and we had inducement for our zone. I'm just going to actually rewind price action here. We can see this instance is quite different. Now, you've got the clear imbalance like the last trade. Obviously, this is bearish imbalance. And the majority of traders would be looking to enter here from this order block. Most traders will draw their order block on the last counter trend candle before the large movement that broke structure. But if you actually look at imbalance or the imbalance indicator, you'll actually see that the imbalance started by here. And with time, you'll actually realize that mitigated imbalance is sometimes very likely to get mitigated again. The market has had time to replenish orders if the order block is old enough. And you can actually see that this counter trend candle didn't actually get mitigated by this candle here. So if you did go onto a lower time frame, you'll actually know that there is imbalance left in here. And we've got clear liquidity built up by here, guys. Now, why is this important? It means that this zone is likely to get swept before rejecting. So me and my community members, we did have our zone, our stop loss set to the swing high. And if we play price now, we can see that if you simply had your order block here, you would have been taken out. Even if you had your order block here, you would have been taken out. Now, I do also teach my community members how to get involved in what I call a Vega entry, where we draw our order block like this at the top of the order block. But just to ensure you do get tagged in every instance, or the majority of instances, it is best just to leave it at the bottom with your stop loss generous, just to account for all this liquidity built up. Now, at this point, you've got more liquidity built up by here, and by here. So we were very confident that this market was going to break down. And although it hasn't hit our take profit yet, we have had a great day of trading. We also had members get involved at the order block here on this fresh imbalance caused after this small minor swing break. And this is currently where we're at. Now, this trade was called out in my premium community, and although I did call out this trade myself in my analysis channel, many of my students did take this trade using their own analysis and initiative after studying my course. So big shout out to them, and massive respect to 3 of you for actually passing top firm assessments today. I do feel like a proud father, as this is our first London Open trading together.